Let's do it. Hello and welcome to the Rules of Investing, brought to you by Livewire Markets. I'm your host, David Thornton. Short sellers have had a tough time of it over the past decade. The era of free money lifted all boats, including companies that would otherwise be candidates for short selling. Today's market is radically different. Central banks have lifted rates in a desperate attempt to control inflation. Global equity markets have performed well, but much of that can be attributed to the tech titans of the Nasdaq. Consumers have less money to spend, company costs are up, and top-line revenue is down. This is fertile hunting ground for short sellers. Short selling is risky and beyond the capacity of most investors. But that doesn't mean normal investors can't take on board short sellers' methods and positions, and steer clear of certain companies accordingly. I speak to a lot of hedge fund managers about their methods, but most aren't willing or able to expose their actual short positions. Dr. David Allen, who manages Plato's Global Alpha Fund, has no such qualms. In this episode of The Rules of Investing, Allen explains his red flag system for identifying shorts and some of the companies it's identified. He also discusses his long process, which draws on elements of growth, value, and quality. And it wouldn't be an episode of ROI without Allen naming some of the companies he has high conviction in right now. And now a word from our sponsor. Research shows that experienced investors are looking for an edge. As the first ever sponsor of Livewire's Rules of Investing podcast, Bell Direct is offering exclusive access to 3 current Bell Potter stock reports every week for a limited time, and the chance to win a share of 3 million Velocity Frequent Flyer points, which we will explain at the end of this podcast. Dr. Dave Allen, welcome on the Rules of Investing.
Thank you very much. Thanks for having me.
All right, I'd love to go back. You have a background as a professional athlete in rugby union, or as us Victorians like to call it, backwards ball. What did you take away from life as an athlete, especially as it pertains to investing?
Yeah, fair question. Like people, often talking about, what are the learnings and analogies. I guess the biggest one for me is that investing, like rugby, like AFL, is it's a team sport, and it's about the people. You can. If you try and play as an individual and try and do it all yourself, then you'll invariably come up short. The collective effort's always going to be stronger. The collective ideas are always going to be better, and that's definitely something that all sporting teams these days they're not top down and dictatorial. They're very much bottom up, sharing of the best ideas, and so it's very much the same in investing. We're fortunate at Plato. We've got some great minds there with over 20 years experience each, so we can draw upon all those ideas and synthesize the very best thinking all around.
And then from there, it was about 15 years running hedge funds at JP Morgan with a PhD from Cambridge in the middle of it. Take us through those experiences and what you took away from them.
Yeah, I was very, very, very fortunate. It was fantastic experiences to be able to study at a place like that with people that are 1,000 times brighter than I am. And I got back there and managed to play a bit more rugby there as well. The experience at JP Morgan, I was very fortunate to fall into a fantastic group. I think when I joined JP Morgan Asset Management in London, we had 18 billion under management, 18 billion euros, and that grew to 75 billion at the peak. And I had some incredible mentors over that period. My boss, the CIO, was he actually had a PhD in artificial intelligence way back then, as well as a master's in psychology, degree in biology, and was very much about the best way to evolve ideas and get an edge over the competition is to be multifaceted and to draw upon different disciplines and get the best thinking out of them, and get away from that group think where you employ everyone from who did a Bachelor of Commerce and think you're going to get interesting ideas. So that was I was really, really lucky with that, and in that time, as well as being involved with lots of great individuals, went through some pretty incredible times in markets. We had Brexit 2016. We had the GFC, which hit the UK incredibly hard. And, they say that, sometimes you learn more in a couple of weeks than you do in the preceding 8 years. And it was very much like that in the GFC. So many learnings about how to preserve capital and how to hold your nerve in those difficult times. Definitely was much better investor after that period.
How did you manage your positions during the GFC?
Yeah, do you know what? We actually, going into as the financial crisis worsened, we were making a lot of money on our shorts. We probably got a little bit greedy. We reloaded those shorts as the market trended down, and those incredibly distressed names, and it looked for all money that they'd go bankrupt and go to zero. And then all of a sudden you've got central governments and central banks coming in and underwriting everything and providing a backstop. And even though we were right in a sense on the fate of these companies, we got really badly burned on those short positions, which was that's the big learning that we had out of that. So the risk management on that short side is totally different than what it looked like then.
Looking back, could you have known that governments were going to put a floor under the whole thing?
Yeah, sure. Like I guess at the time I was a pretty green investor with less than 10 years experience, and with hindsight, definitely could have structured things differently. Now, to this day, that's hardwired into our investment process that whether it's a distressed period in the markets or not, if a stock itself is distressed, we won't actually be short that name. If a stock is a little bit distressed, that's fine. But if a stock, for example, is off 70 to 80% off its peak, it may go down a little bit more, but the risk is very much asymmetric at that point. It comes out with just a little bit of good news at that point, and say it's gone down from $10 to $1, it could easily go up to $2. And if you've reloaded that short position, you've lost 100% on your position and given up all that good work that you've achieved so far. So the risk management around the shorting side, some things you can't learn out of a textbook. You can only learn by going through and suffering. But the good thing is you'll never make those mistakes twice. So, much the better for it, I think.
You're now running long-short strategies at Plato. Let's talk about process. How do you go about generating your alpha?
Yeah, that really good question, which comes to the heart of everything. We're a big believer in that you want the very best value companies, the very best growth companies, and the very best quality companies in your portfolio at all times. When I was at JP Morgan, we had a team of 45 incredibly bright investors, and we spent over a decade trying to develop models to style time, essentially to say, okay, now's the time to rotate into growth, or now is the time for quality. And after all that time and all that effort, we never actually decided to run any money on that style timing process. And the reason is because you can get a back test that looks great and you feel warm and fuzzy about it, but we never had confidence that going forward out of sample that you'd be able to predict well enough. And there's great examples of that this year. Like, who would have thought, like, value shot that lights out last year, and then everyone was like, oh, growth's done, interest rates are going through the roof, it's just going to be an absolute car crash. And then look at where we are. Like, every single month this year, MSCI World has trended upwards. Nasdaq's up something ridiculous in the 30-odd percent. So people who are aggressively, and everything, logically said, this will be a time for value, but it wasn't. AI comes along, and most people hadn't heard of ChatGPT till last November, and then suddenly markets ignite. So I think it's very dangerous to take big, bold style views. In retrospect, people think that they can make them, but you could easily be wrong and then rotate out, and then it switches and then be wrong again and absolutely hemorrhage capital. So our approach is very much designed to be an all-weather approach, where we've always got the best value companies, the best growth companies, and the best quality companies globally. We've got a universe of 10,000 stocks that we can find. So I guess like a few of those examples that come to mind is in the value bucket, if you like, BMW. Like BMW, incredible storied company. They've got they're selling at a PE of 6.5 times. 6.5 times. That the long-term average for BMW is 12. Okay, and this is an incredibly well-run company. Incredible brand recognition around the world, and yet they're selling at 6.5 times. People say, "Oh, well, they're not growing in the EV space." Well, actually, they're growing their EV fleet at 100% per year. They could easily be all electric within a decade if they wanted to. Tesla's growing at 35% per annum. So I know with Tesla at a PE of 72 times and BMW at 6.5 times, it's a huge discount. And I certainly know where we would rather be. So having great value opportunities, that's the first leg. Great quality opportunities. So a great quality name that we like is ASML. Now, this is a company I've known and invested in for a long time, and it's how we look to play the AI revolution. I personally think it's really, really difficult to know who the downstream winners in AI will be. A good analogy here is in the early days of the internet, our older listeners will remember your Ask Jeeves and your Alta Vista and this sort of thing, and your Yahoos even. But no one really knew who would be the winners of search. And then Google comes along, early 2000s, with a better algorithm and just wipe out the competition. Okay, anticipating who the winners and losers are going to be is incredibly difficult, even for people in the inside. So for emergent technologies, we will always play a picks and shovels type approach. So picks and shovels, for us, that means ASML. So they have a virtual monopoly, about 90% market share on the deep ultraviolet lithography machines that are necessary for all of the most advanced chips involved in AI. So they're the very apex of the supply chain. They're a company with 20 billion euro in revenue and a backlog of 40 billion, margins of 70%. So incredible quality name, very well poised. Great growth name that we like in the portfolio. This is a company I've invested for over a decade, and in the pharma space, people think of the biggest pharma companies in the world, and they'll think of your Eli Lilly's, your AstraZeneca's, your Merck. Well, Novo Nordisk, Danish company, is now the biggest company in Europe and the third biggest company in third biggest pharma company in the world, and they're great. Every few years, every couple of decades, even a seismic shift comes in the pharma space where a new drug upends the industry. You had penicillin in the 40s, you had Prozac in the 80s, in the 90s and 2000s, you had the statins. Last decade, of course, the revolutionary immuno-oncology drugs, but now I think the blockbuster story over the next 10 years is going to be these anti-obesogenic drugs that are projected to be 100 billion revenue a year market within the next 5 or 10 years.
So are they still going through trials, or are they on the market now?
Yeah, well, it's funny you say that. I bumped into a buddy of mine on Sunday, and it was old school buddy. I hadn't seen him in a few years, and he'd always been a big boy. And I saw him, and he looked great. And I go, mate, what's the secret? What are you up to? And he goes, Ozempic. And anyway, his dad was a pharmacist that probably helped him to get the off-label access, because in Australia you can get Ozempic, which is the drug used for diabetics, but it's not approved for obesity at this stage. But that's due to shortages, because this drug is in such demand that they can't produce enough of it. Okay, so they've had to restrict it to just people with diabetes. But that problem will get solved by the end of this year, maybe early next year. That's really our philosophy. Always have the best value, the best growth, the best quality names in your portfolio. We had great performance last year, which was a value bear market. We've had great performance this year, which has been a growth bull market. I think investors increasingly don't want that fast and famine where, you beat the benchmark by 30%, then you give up 30%. They want more. There's an interesting fact I learnt the other day about Don Bradman, and obviously the greatest cricketer of all time, averaging 99 or thereabouts, and how many sixes he hit in his career. And you'd think, especially by these days standards, he must have hit a bunch, but I think he hit 5. Okay, and his whole philosophy is, well, you can't get out if you only hit the ball on the ground. And that's very much our approach, rather than just going all in, going, it's all about AI or it's all about mega cap tech or something like that, where we try to have lots and lots of thematics expressed in the portfolio and try and hit singles rather than hit sixes. The other leg of the investment process that's really, I think, distinctive is the red flags. This is a bit corny, but Buffett always says 2 most important things in investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And that's very much what the red flags process is about. So we've got about 130 red flags that we will evaluate for every single stock before we trade long or short. And that does 2 things. It really stops us investing in landmines on the long side that are going to blow a hole in the portfolio. But even more powerfully, that's how we generate alpha on the short side, which has actually driven 90% of the alpha since launch.
So it's a 150-50 strategy. So 150% long, 50% short. I got to ask, if the shorts have generated 90% of outperformance, why do you not just invert that equation?
Yeah, that's a really, really good question. Some environments are really conducive to shorts. Some environments are really conducive to long. So in an area where you've got rates dropping, lots of liquidity dropping around, then shorting isn't as favourable, and it's more favourable to be invested long. There's the tide lifts all boats. But where we are now, where rates have, after being low for such a long time, have ratcheted up the most aggressively they have in 100 years, it's really applied the blowtorch to the valuations of so many things. Like that low rates environment inflated everything from Bitcoin to NFTs to garbage companies who'd never made a profit, never will make a profit. Zombies. So they were just kept alive. So that's is a really good environment for shorting, because suddenly the rates are normalised, economic fundamentals matter again, and that's why it's really conducive to shorting. But that'll change. We'll swing back, and certain periods will be really conducive to longs.
So that red flag system, let's dig into that a bit further. No company is perfect. I'm sure the majority of companies throw up at least one red flag from time to time. Do you have a minimum number of flags you need to see before you're like, yep, I've got conviction on shorting that company?
Yeah, sure. 6 and out seems to be the old backyard cricket rule seems to be a reasonable number. But one thing that's really important is that just because a company has a lot of red flags, that's absolutely not a reason for us in isolation to go short. If a company has incredibly strong sentiment and then we won't stand in the way of that. And think, for example, like your meme stocks, they had a horrendous number of red flags. Your Bed Bath and Beyonds and your GameStops. And
they didn't have any green flags.
Yeah, no green flags. But you would be a braver man than me if you wanted to short those names. Some hedge funds that have been around for decades will put out of business shorting those names. The most irrational thing you can do sometimes is to try and be too rational in an irrational market.
Have you ever copped a short squeeze, like the GameStop situation?
Yeah, for sure. I remember with Volkswagen, back in the day, we were on the wrong side of that, and it's a difficult situation because even though eventually the price will fall back to earth, and if you're bleeding P&L in the meantime, then it can be quite painful. One thing that we do with our shorts is we're very, very modest in how we size them. Our typical short's 40% smaller than our typical longs, and it's because you can get these short squeezes. You can get stocks bid for, which we do from time to time. So by being just sensible how you size them, it enables you to generate the great alpha that's available there, but without, really hurting yourself.
With the flags, are you seeing any specific flags at the moment that are coming up more than others, given where we are in the cycle?
Yeah, definitely. That's a great question. Sometimes people ask, they say, look, there's 130 red flags, but is there one red flag that if you could only use one for the rest of your life that you would use? And it would be this: persistently negative operating cash flow. So quite simply, in plain English, it just means a company can't even generate enough profits to cover its interest or any other expenses. It's standalone. It's going backwards, and there is an absolute proliferation of these companies. The phrase "zombie companies" is related to this, and that was coined in 1990s Japan, where all these companies were essentially on life support. They could only survive because interest rates were zero. And interesting, in Japan, you're not seeing many of these companies at all right now. But in Australia, we have a huge number of, we've got the most number of proportion of companies with negative operating cash flow out of any other developed market in the world. And it's made Australia quite a fertile area for shorting, and where a bunch of our short alpha has come from.
So can you name any shorts at the moment you have high conviction in?
Well, within a high conviction short at the moment is commercial real estate. And it's no secret to anyone who works in the city how empty it is. It's like a ghost town on Mondays. Fridays aren't much better. I think COVID has fundamentally changed the way people will work and the flexibility that they desire. And as a result, if you have a building that's it's not an A building, it's not. In the UK, if your building doesn't meet the very highest of environmental standards, you're going to struggle renting it out. So that's people think of the term stranded assets and they'll think about coal mines, but when I look out this window now, and you can see lots of stranded assets that I certainly wouldn't want to be holding those. So a name involved in the commercial real estate that we've done very well shorting, we've made about 25% on it, is Lendlease. What's interesting, I think, about Lendlease is this is a company that since 2009, in incredibly accommodating circumstances, rates have been really, really low, property prices super buoyant, and on a cumulative basis, they haven't made positive free cash flow in a great environment. Suddenly you're in a tough environment where rates are a lot higher, there's a genuine cost of capital, and you've got a change in working habits. To give you an idea, I was speaking to a mate of mine the other day that he is CEO of a listed company that I won't name, and he was saying that they're actually tearing down office space in Ryde and putting and changing it to industrial. Like Ryde, it's not a long way. We're not talking Penrith, and if that's happening, that tells you something pretty fundamental is happening with the way we work.
Any other companies in other sectors, perhaps, that are throwing up some red flags?
Within Australia, this is a name that we're no longer short. We were short, but there's a company called BrainChip, and BrainChip have 23 red flags. Which is, out of the 10,000 companies we look at globally, it's the second most. And when you look at BrainChip, you read their website, and I encourage you to go on their website. If you can work out what they do, then you're smarter than I am. But they're a company that had a market cap, I think, of a couple of billion, towards the start of the year, around that point, and they've got less revenue than some cafes. For companies mentioned a lot on hot copper and these sorts of things, then you need to be very wary. But that's a very good example of a name that we made good money shorting on, but is now a long way off its highs, and the risk is potentially asymmetric at this point. They can do something minor where they get a patent approved and it can go up 10%. So we'll move on and redeploy that capital to where we think alpha opportunities are more favourable.
You mentioned there that they have the second highest number of red flags. Can I ask who has the most?
I think I have to check with the compliance because we
That's
are
all
sure
right.
that.
But that said, you're very open about talking about your shorts, Dave, and I get a lot of hedge fund managers on the podcast, and they're very reluctant to talk about their short book at all. They can talk about process, but they don't want to name often even past shorting positions. I think it's because they don't want to lose access to the C-suite, but you clearly don't have the same concerns.
So I guess part of that is, like, in terms of access to the C-suite, I think 10, 15 years ago that was incredibly valuable, but I don't think it really is now. Regulations being tight as they are and as they should be, you can't go and have a face-to-face with a global listed CEO, CFO, and for them to give you information that's really not in the public domain already. But what can happen is a good CEO is also a really good salesperson. And you never come out, I don't think I've ever come out of a company meeting being much more bullish on the prospects of that company than I was before that. So I don't think it's good bang for your buck in terms of those company meetings, and it can also compromise your objectivity. So that's not something that particularly concerns me.
Pivoting away and talking a little bit about cult of personality, as you just mentioned, Qantas is in the public sin bin, but you're actually pretty bullish the stock. Why is it not a value trap?
Yeah, no, that's a very, very good question. I probably should emphasise that the Plato Global Alpha fund that we're talking about, or that I run, that's where we're long. And there's other Plato funds that have various ESG sensibilities that are quite different, and that's absolutely fine. If you look at one thing I agree with is that there are various red flags on Qantas. Like, one of the things that we look at to get an idea of, I mentioned the importance of people and team and culture at the start of the podcast. How do you gauge that for a company from the outside? One of the ways we do it is to use online review systems where employees can place reviews and say, oh, it's great working at Livewire, they've got a great culture, and they evaluate it and it gets a star rating. And there's very deep ratings you can get on companies like Qantas, and you can see that through time the morale and satisfaction people are getting at Qantas is not surprisingly going through the floor. Out of the 20 sort of comparable airlines we look at, and when we look at that data, Qantas is right down the bottom in terms of that culture and morale. So that there's lots of red flags. There's remuneration that is pretty out of whack with the brand damage that's gone on. There's record complaints to the ACCC. So there's lots of stuff, right? And and the biggest red flag is we're finally, after COVID, me and my family went to Hawaii, and then they bungled the luggage, and I was sitting on Waikiki Beach in my tracksuit pants, sweating bullets for a couple of weeks. But it's important, I don't want to, you never want to invest angry. Just because I don't like I'm disappointed at a company or, frustrated with a company.
You don't want to short them on Waikiki Beach.
Yeah, like that. So when a mate of mine read some research that I'd done on Qantas, and he gave me a call straight away, and he's super pissed off with Qantas, and he's like, and he knows the company well, and he gives the bear case, and he's steamed up, and I go, mate, there's a bit of noise in the background. Where he goes, I'm in the business lounge at Qantas, but he's just like, I get it, but in lots of cases you go to book something else and there's no option. They've got 62% market share in Australia, right? And so at this valuation, like what's the free cash flow? It's like or the PE, it's like 5 or 6 times. Like if you look at it on a free price to cash flow basis, I think it's in the cheapest percentile that it's ever been. That gross margins have gone up from 20 to 25%. The sell side's just upgraded the revenue and earnings projection. So is it have they conducted themselves in a great way? Not at all. But in terms of are they incredibly profitable business with high market share? Yes.
A lot of that, however, though, has come from skimping on CapEx. I mean, they should have been buying planes and they weren't.
Yep.
Right.
And that's
and now they've got a bloody big bill.
Yeah, for sure. And that's absolutely true. And I think their numbers aren't going to be as great going forward. It's been window dressed a bit, but nevertheless, I think they're in a pretty good position. The labour force is way smaller than it used to be, and I know that's a sad thing. But in terms of the overheads that they face and how they've outsourced things, then from an equity holder's perspective, you can see how that would be favourable.
So it sounds like, is that a market share play or a too big to fail play, or a bit of both?
A bit of both. Like Qantas, they're never going to let go bust, are they? And when you can get on that sort
Clearly.
of clearly, when you can get on that sort of multiple, they've got new CEO. Hopefully, reset the narrative at some point. Qantas, if a great chart to look at is the price chart of Qantas overlaid with their earnings forecast, and it moves in lockstep. Okay. Just, the second the earnings forecast go up, the price ratchets up, okay, and vice versa. Except for the last month or two. You've seen a decoupling. The price has fallen off a cliff and the earnings forecasts have continued to go up. Ultimately, what matters in markets is fundamentals like earnings, revenue and cash flow, and I think that relationship will reassert itself the company will prove to be a good investment over the next 5 years.
You spoke earlier about the importance of sentiment when you're shorting and the threat that poses to jump out and bite you. Does the inverse also apply here with Qantas, where public sentiment is just so bad?
Yes,
that's almost a basis for going long.
Yeah. So
because it's going to revert to the mean to some extent, you'd imagine, as things settle down.
Yeah, I think so. Like when I talk about sentiment, the main things that we are looking at are, firstly, we don't look at sell-side consensus numbers. If a company will typically might have 20 analysts covering it, there's usually 2 or 3 that are really sharp, that move early, the rest sort of herd to after the fact. So for every company, we identified who these star lead analysts are, and we watch them like a hawk, what their revenue, earnings, cash flow, price projections are, and the second that they're changing their numbers, we're potentially changing our views. So their sentiment is still, quite bullish on Qantas. In terms of sentiment of man on the street, it's obviously quite negative, but that doesn't seem to be flowing through to their earnings, which is the most important thing.
This all kind of speaks to the idea that a good company doesn't necessarily make a good stock. And vice versa.
100%. Like there's, you look at like a couple of incredible companies like Ferrari or Hermes, and unfortunately, my wife also thinks that's an incredible brand. But they're companies that have 40, 50% return on equity, incredible brand equity, but they trade on PEs of 50 times and at big premiums to their discounted cash flows. So they're great companies, but I don't think they're necessarily great stocks.
Let's talk nVidia. That's obviously been the standout stock, returning to about 230%. Is it still an attractive investment at these valuations?
Yeah, like we look at it and we think the valuation is demanding, but it's not something that we like. We're still invested in it. We've been invested in it for some time. We've trimmed that position a little bit because the valuation it definitely is toppy, but. Well, we just see it's going to be such a long-term winner in that space that we're pretty happy with that positioning. Again, a hallmark of our approach is, we don't hold 10% of the portfolio in nVidia. We don't hold 10% in Tesla. That we're, even that Qantas position that we talked about, it's like 0.5% of the portfolio. So if we get it wrong, and we absolutely do, like a top quartile fund manager only gets 55% of their stock picks right, because markets are quite efficient, they're quite hard to beat. We think we can get in the high 50s, about 6 out of 10 right, but we try and size our things in accordance with the fact that we are going to get them wrong. So we've got modest overweights in nVidia, but nothing massive.
So you lean more into the diversification camp rather than the high concentration school of thought in investing? Yeah, definitely. Like I think what makes investing so fascinating is there's no right or wrong way. You look at Buffett, revered as the best investor of all time, and his whole mantra is, put all your eggs in one basket and then watch that basket, and that's undoubtedly can work incredibly well. But at the other end of the spectrum, the most successful hedge fund of all time, Renaissance, they've done 35% annualized returns for 25, 30 years, and that's after fees of, wait for it, 4 and 40. So just like ridiculous. And they have thousands of positions. So I don't think that there's any one right or wrong way. Our preference is certainly more diversification than your typical 20 stock portfolio, and that's really reflecting what I mentioned before, that even the best investor, your hit rate's not that high, so you want to make sure that you're not all in, and if you do get something wrong or something happens that you didn't expect, maybe you're short a name and it gets bid for out of the blue, that you don't do yourself a real disservice. Okay, we always finish with 3 favourite questions in our podcast, Dave. Question 1, what's one thing investors are getting wrong about today's markets?
Well, it's actually relates to just what I said. There's a real view that the only way to generate attractive returns is to be super concentrated. And, from a high level, it kind of makes sense. Oh, yeah, you need to take big punchy bets. But our performance, like we're generating plus 8.5% over and above what the MSCI World is doing per annum. We've done that with hundreds of stocks in the portfolio. We do that. And how do we do that? Well, we've got this 150-50, so 150% invested long. So we've got 50% more firepower in our best ideas, and we've got this 50% short engine as well to generate alpha, which has been a great source of alpha. So I guess, that's the biggest mistake, I think, for me, that people think that you've got to be super concentrated, otherwise you're not going to get good returns. There's lots of ways about this.
So you're eating that free lunch?
Well, I'm trying my best.
Question 2, could you share a story of a big win or a big loss, or both, you've had in your investment career? What happened and what did you take away from it?
Yeah, great question. So I would say that back in 2014, I was invested in a Spanish tech company, And this company, it was called Let's Go X, and it had been an incredible investment for us. I think it had gone up like 45-fold, and we're thinking that we were, pretty hot stuff making that. But markets, as they do, have a way of humbling you. And I think it was soon after the Spanish Prime Minister came out and lauded this company as it's going to be the next unicorn, and it's the shining light in Europe, that it's uncovered as a massive accounting fraud. Stock price goes to zero, CEO gets indicted for fraud. Okay, and we're like, wow. Okay, what did we miss there? You never. There's no problem making a mistake. We all make them, but let's just make sure we don't make the same one twice. So when we did the post-mortem, we said, well, actually, there's two things that we missed. Well, maybe three. The first one was they were doing public Wi-Fi, and whenever I was in an airport traveling around Europe, it never worked. Right. So there. The second one was they had an auditor that no one else in the world was using. Okay. The third one was they were paying that auditor a really strange amount, only 0.02% of revenue. And typically,
what would a normal auditor charge?
About percent for this type of company at this life stage. And anyway, we said, okay, well, let's get as much data as we can. So we've got 10 years of data across 10 different countries, so tens of thousands of stocks, and said whenever a company is using a very obscure auditor, what does that actually mean going forward? And sure enough, if a company is using a very unusual auditor or small auditor, then going forward, they tend to be more risky and tend to underperform. Okay, and it's funny, like the second that someone's pointed that out to you, I guarantee the next big fraud or accounting manipulation that you look at, they'll have an unusual auditor. So a good example, Adani, accounting manipulation, and they were using auditors that were too junior, too green, that didn't have the sophistication to understand the web of transactions and corporations that they were looking at. If you look at Bernie Madoff, had his uncle up in Queens doing the books, so same sort of thing.
I guess the prototypical example would be Enron.
Yeah, so Enron, I can't remember who the auditor was there. But Enron, do you know what? They were a poster child for related party transactions and special purpose vehicles. Related party transactions present in pretty much every fraud that you look at. So the great thing about that is that actually spawned the red flags approach, where we went through every accounting manipulation and bankruptcy we could get our hands on over the decades and built up this toolkit. So we've got 130 red flags like that, like the obscure auditor. We make sure that any company we invest in has a low number of red flags. The names we're short tend to have a high number of red flags. I still remember Volkswagen had 17 red flags going into emissions gate, their cheating scandal. Of course, it doesn't guarantee there's going to be fraud, but it just makes it a lot more likely. That was a name, that was a big loss. That was we just learnt so much from, because it sort of opened our eyes to a whole new way of investing, which has been very, very profitable to this day.
Question 3, if markets were to close tomorrow, hypothetically, for 5 years, and you could only own shares in one company, what company would that be and why?
I would say, even though it's going diametrically opposed to what I've just said about the diversification, the anti-obesogenic drugs, I think, are phenomenally exciting. They, Eli Lilly and Novo Nordisk, there will probably be a duopoly there, but it could very well be a $100 billion revenue market before long, especially when it's been described as the Swiss Army knife of, or potential Swiss Army knife of medications, where it's shown promise for addiction, arthritis, obviously 20% reduction in heart disease, diabetes. So it is quite phenomenal. Obesity is the 4th biggest killer globally, but there's a whole bunch of other killers like high blood pressure that will be will be improved with these drugs. So I think that's an incredibly exciting space to be in, and they could be just absolutely dominant in the pharma space in years to come.
Dave Allen, this has been a great chat. Thanks so much for coming on The Rules of Investing.
Thanks so much for having me. Really enjoyed it.
I hope you enjoyed that episode with Dr. David Allen. Thanks to Bell Direct for their support of this podcast. And remember, for a limited time, you can get 3 Bell Potter stock reports each week, and you will go into the draw to win a share of 3 million Velocity Frequent Flyer points. So go to Bell Direct, check the full terms and conditions, and look for the Livewire logo to get your Bell Potter stock reports now. Competition ends 31st October 2023. Entry conditions and eligibility criteria apply. New South Wales Authority number TP/02866. South Australia permit number T23/123. ACT permit number TP23/01592.